Hi, I'm Jim, and I was retired. This week's economic numbers are worrying. June's inflation numbers rose for the second month in a row, and this morning the University of Michigan reported that consumers expect inflation to reach 4.5% a year from now. Are we really heading for higher inflation? Also, this week, the Fed's policymakers decided to hold its target rate steady for the fifth meeting in a row, much to the chagrin of President Trump, who has been pressing Chairman Powell to lower rates. What does all this mean for DIY retirees? Should we worry about the signs of building inflation for the second half of 2025? Stay tuned for how one DIY retiree looks at all of this inflation news to manage my investment portfolio. Now, a retiree needs to worry about inflation because we can't ask the boss for a raise anymore. Inflation hits our fixed incomes, and the wrong monetary policy can wreck the economy and our investment portfolios. Now, stick around to the end of this video, and I'll discuss how the current inflation numbers influence where I'm parking my cash. Let's dive in. Now, both measures of inflation increased for a second month in a row. Earlier in the month, we saw the Consumer Price Index reach 2.7% year over year. And this week, we saw the Fed's preferred index, the Personal Consumption Expenditures, or PCE index, rose to 2.6% in June. Now, I checked this morning and saw that the University of Michigan's one-year inflation expectations number dropped to 4.5%, down from 5% a month ago and 6.6% back in May. But it's still way too high. Now, the New York Fed's Consumer Expectations Survey also dropped a little bit to 3% in June from 3.2% in May. So what we're seeing is actual inflation numbers are rising and inflation expectation numbers are lowering, and they're all beginning to converge at that 3% level when the target should be 2%. Now, the Federal Reserve's policymakers met the day before the PCE number came out, and they released their statement on Wednesday, deciding to keep the federal funds rate at its current 4.25% to 4.5% level for the fifth straight meeting. Now, just a month ago, the FOMC's summary of economic projections pegged the median year-end Fed funds rate would be 3.9%. So that suggests that there are still some cuts to come. But when? And there's a growing divide about the pace of these cuts. Now, President Trump was not happy with Chairman Powell, as this post on X notes. He is too late and actually too angry, too stupid, and too political to have the job of Fed chair. Oliver Blanchard, a European economist, sums up a lot of the objections people have to the president's tone. Trump's attacks may have made any decision to lower rates look like capitulation, and if anything, this makes it less likely to happen. And there on the right, even balanced reporters note that these are confusing times. Setting interest rates is something more art than science, especially when the economy keeps defying predictions, a reality that the Federal Reserve confronted head-on Wednesday. I'll agree, the times are tough to read, folks, but that's the Fed's job. Now look in the details below for links on some of the articles I've been reading about inflation and the Fed's actions, including this article about Trump urging the Board of Governors to take control of monetary policy if Jerome Powell doesn't slash rates soon. I'm not sure our president understands how the Federal Open Market Committee, the Fed's policymakers, actually work, so let me review. The Fed has a dual mandate of price stability and maximum employment. People call those who are concerned about the labor market doves, and those that are concerned about price stability hawks. Now, the president appoints the chair of the Board of Governors with the advice and consent of the Senate. and Chair Powell is the most visible face of the Fed. But there are 6 other governors. 2 of them were appointed by President Trump in his first term. The rest have been appointed by President Biden. Of these 6 governors, only 2 are considered hawks, the ones that Trump appointed in his first term and those that dissented at this last meeting. The rest of them can be reasonably called doves. Now, to ensure that monetary policy represents the whole nation, Congress gave votes to 5 of the 12 presidents of the regional banks in any given year. Now, the president of the New York Fed always votes because that's where the open market desk is based, along with 4 other presidents whose votes rotate so that voting members always come from different parts of the country. In 2025, the presidents of Chicago, Boston, St. Louis, and Kansas City will vote. Now, of those, most are considered doves. Only 2 of them are considered hawks. But I'll note that all the presidents went along with this last statement in July. Only 2 governors dissented. And in 2026, Cleveland, Philadelphia, Dallas, and Minneapolis presidents will vote. And again, they're a mix of hawks and doves in those presidents. And in 2027, 3 more presidents in Richmond, San Francisco, and Atlanta will get to vote, along with the Chicago president again. Cleveland and Chicago alternate. The rest are in like 3-year rotations. Now, most of these presidents, as you see around the table, are considered doves. Only a few are considered monetary hawks. Now, the big question is the chair. Chair Powell, his term will end in May of 2026. And so who will that chair be as we go through 2026? And will that be a hawk or a dove? Now, the 2 governors who dissented in July, Michelle Bowman and Christopher Waller, who is one of those that is likely to be up for the chair, said that they would have preferred to lower the Fed funds rate by a 1/4 point at this last meeting. In statements released today, Waller cited the lack of evidence that tariffs cause inflation as a reason to go ahead and reduce the Fed funds rate. And Michelle Bowman cited the weakness in the labor markets, which turned out to be prescient given today's labor report, which showed clear weakness. Now, both of these were appointed by President Trump in his first term. So do we describe them as dovish or hawkish dissents? One of the articles that I'll link below is a St. Louis Fed article with the history of FOMC dissents. Here is that article that I found at the St. Louis Fed on the history of FOMC dissents. And it had this Excel spreadsheet, which it updates, including all the way up through this last meeting. I took this data and downloaded it into numbers. Now, when the numbers came in, I took a look at it, added today's meeting to it, but then I also categorized it for a year and the number of governors dissenting and the number of presidents dissenting. I also looked at the total votes against column and did these 2 charts. So the first thing I did was look at the number of dissents in 2016 to 2025 to show you that 2 dissents is not that uncommon if you include the presidents. This is the meeting here with 2 governors dissenting. But if you can see, in September 16, 2020, we had 2 dissents, including presidents. And in September 18, 2019, we had 3 dissents. Likewise, we had 3 dissents back in September 21st in 2016. So the number of dissents generally doesn't get any more than 3 at a meeting, but it has happened in the past. A lot of people have talked about that this is the first time that 2 governors have dissented since 1993. And my category sort in this chart shows that. Here's the number of Dissents. Now, this is categorized and lumped by year, so that'll include several meetings in each year's row. But if you could see, it includes governor dissents and president's dissents. And in early years, it was often governors that dissented. And it's only been recently that it's been more frequent that presidents have been dissenting rather than governors. Here is the year in 1993 when you last had 2 governors dissenting. The rest have been 1 governor dissenting, sometimes joined by presidents. This is indeed unique if you look at that approach. But again, in a way the FOMC works to build consensus, all the voting members, all 12 of them, governors and presidents, have an equal shot at the vote, and they can either agree or dissent. Now, my prediction is that the Fed will finally begin to cut again in September and may cut one more time before the end of the year. And I also think that we're going to see more dissents, including some from doves, if the FOMC appears to acquiesce to Trump this fall. Hey, please subscribe to my X feed as well. It's also at I Was Retired. I'll comment on inflation and my DIY retirement there as well as on the YouTube channel. Now, to wrap up, the Fed has frozen its policy rate for too high. It's above where it should be given the state of the economy. But with labor market now weakening and inflation ticking up again, it may have worked itself into a box. Now, to protect the assets that I need in bucket 1, I'm looking to continue to focus on high yield savings, money market funds, treasuries, T-bills, and shorter notes treasuries, and CDs. And I favor terms for bucket 1 that are less than 3 years. Now, in this video here, I describe how I use individual tips and I-bonds to provide inflation protection for bucket 2 assets. Longer term, I'm staying invested in equity in bucket 3 as the best protection against inflation. So what is your plan to keep cash safe? What are you doing at the prospect of higher inflation? Drop me a comment below. And be sure to share, like, and subscribe to this channel for more DIY retirement tips. Now I'll close with my standard warning. I am not an economist or a financial planner. I'm just a DIY retiree sharing my ideas. Always do your own due diligence and seek out a professional if you need one. See you next time.